Suyash Chaudhary, Head of Fixed Income at IDFC, now joins in on the show. Suyash, to start off with, you have seen some semblance of recovery coming into the currency, but how do you believe it is going to read into all of these global developments that take place? Do you think that the stability is here to stay?
Well, on the margin, a lot has improved for the currency per se and India broadly. So if I look back over the last 15 days, there were really three worries. One was a geopolitical worry around Syria. The other was the Fed leadership starting early next year and therefore the guidance for future Fed policy. And the third was the problem of dollar supply to India. Now, if you were to look at each of these in turn, they have all improved. So the Syria risk is on the back burner, at least in the near term. There is expected to be more continuity in Fed leadership with Summers having dropped off the race. And most importantly, the FCNR discounting, or rather the swap discounting program being offered by RBI, along with the relaxation on swaps on overseas borrowing limits, altogether can get us around $15 billion. If you combine that with the reduction in dollar demand that has happened on account of oil marketing companies going out of the interbank market, I would think the scenario looks much better for the next 2 months at least.
Given that we did see a major divergence this time around in the food inflation data for WPI and CPI, how are you reading into that?
There are two somewhat transitory factors that one has to potentially look through if one talks about inflation. One is the unseasonal spike in food prices, largely owing to disruptive rains in parts of the country, which is what is playing through in inflation right now. The other has to do with rupee depreciation. So if you look at each in turn, the food articles problem has to do with shortage in the near term. Of course, there's a larger supply bottleneck issue that won't go away in a hurry. But there's a near-term shortage which may potentially get rectified once supply improves, which is expected to be the case once the new crop comes into the market. If you look at currency depreciation, yes, that's a challenge in the near term. But I think the demand destruction that is happening side by side should ensure that the core readings on inflation remain relatively well behaved. So it is really the RBI's choice whether to look through these temporary factors or to react to them.
Suyash, on account of the fact that the inflation pressures continue to remain on the rise, that perhaps the kind of recovery that we're seeing in the currency markets isn't here to stay for certainty that the RBI will remain status quo?
Well, there's a reasonable probability that in the policy due on Friday, status quo is maintained, but an important differentiation that needs to be made is, with respect to what really status quo means. So the 10-quarter operative rate right now is purely on account of a currency defense mechanism. And that needs to be unwound once, as per RBI's own stated objective, there is some semblance of stability in the currency market. I think inflation control is really the prerogative of the repo rate. So when we say status quo, we can easily see an unwind of the current temporary measures over the next month or two, whereas the repo rate remains on status quo for a longer period of time.
So how do you think the yields react, Suyash, to that? One, depending on the action, of course, that RGR takes, how do you think the yields react to it?
So, in the near term, there is a lot of uncertainty, chiefly on account of the fact that if the 10-quarter doesn't get at least partly unwound on 20th September, the bond market will face some pressure in absorbing the auction supply that is due over the next 2 to 3 weeks. And therefore, in the near term, there could be some pressure on bond yields depending upon what kind of signal RBI gives on the 10-quarter overnight rate. Over the medium term, we are much more sanguine. We think India macro on the margin is improving. We are looking for a much lower current account deficit this year compared to last year. We don't see structural inflationary pressures from the demand side. Finally, and which is possibly the most important as far as the macro outlook is concerned, one has to look for the government springing back into action with respect to the fiscal deficit. To our minds, that is the weakest link in Indian macro right now, much more than current account deficit.
And how do you believe we are likely to attain those targets on the current account deficit front? Because, you know, the government seems fairly upbeat, and they seem fairly certain that they will be able to do the same.
You know, one potential change that needs further observation is over the last 2 to 3 months we have seen a substantial jump in our export growth. Now, the very factors leading to fears of QE unwinding, which is essentially better growth in developed world, is also leading to better export growth for us, with currency depreciation playing a part as well. So if you were to take data or forward-looking data coming out of government at face value, we would think over the next 3 to 4 months, export growth can easily continue to print in double digits. Furthermore, there is work that has been done on non-essential import demand, and we hear further measures can get taken on oil import demand as well. Finally, if you look at the transfer side of the current account, you know, remittances should be better on account of rupee depreciation, etc. So all told, we are quite happy to take the finance minister at face value when he says that current account will get contained to within $70 billion.
All right, Yash, we'll leave it at that. Thanks so much for taking the time out and joining us and giving us that perspective. Really good having you, as always, and look forward to having you more often.